Good evening. This is Dave Steck, and I want to welcome everyone to tonight's webinar. We're going to talk about private lending to real estate investors using your IRA and how you and your family can create passive, recurring income and wealth and keep it. This is Dave Steck, and one of the things that you're going to find during the course of the presentation is we refer to this whole concept of private lending as just being the bank. So as you hear me refer to it, you'll understand why. Now, this long tagline that I just read to you isn't just a long tagline. It's literally what my sons and I have done to create and keep millions in incremental revenue, both for ourselves and our companies in the last 8 years, while I've added two zeros to my net worth after retirement. Before I jump in, I want to thank Carl Fisher, CEO of Camaplan. Carl has heard me speak at a few conferences and asked if I would share this with his Camaplan community tonight, and I'm honored that you're on the call. So with that, let's get started. If you're on this webinar, you fit into one of three groups, and this webinar is for all three of you. Number one, you've never heard of private money lending to real estate investors before, or you know about a private money lending or what it is, but you haven't made a loan. You're actively making private loans with your and even others' money. But the one thing that we have in common, all of us, is we'd all like double-digit returns, preferably passive and recurring rather than active, and with the least risk possible. So let me start tonight by explaining the money game. Many years ago, when I was trying to explain the money game to my sons as they were growing up, I basically drew a triangle and said there are really three things that you need to understand if you're going to win the money game. Number one, how to generate cash, otherwise known as income. And that income comes in two forms, both active and passive. And if you're really fortunate, it can be passive and recurring. Second, you need to accumulate wealth, otherwise known as assets that both throw off income and go up in value through appreciation. And most of you know that there are three forms of appreciation. There's what I'd call instant appreciation, where you buy an asset at the right price at a discount, forced appreciation, where you remodel it or convert its use to something else, and market appreciation. And if you can both generate income and accumulate any of those three forms of appreciation, you win the wealth accumulation game. And then lastly, you've got to keep it. Somehow preserve it. Don't lose it. Make sure that you don't give it up to taxes. Make sure that you do other strategies that ensure that you preserve your capital. So I always like to start by talking about keeping both and the question that you've likely heard. Which would you rather have? $1 million in cash right now, or a penny that doubles in value every day for 30 days? Well, many of you have heard this answer, and that is that a penny that doubles in value every day for 30 days on day 30 is now worth just under $5.4 million. I know it's hard to believe, so I always like to show the proof. It starts at a penny, goes to 2 pennies, and then 4, and then 8. And by the time it gets to day 28, it's 1.3 million, doubling to 2.6, and then to 5.4 million. Now, let me ask you a slightly different question. Would you rather have the same $1 million in cash or the penny doubling in value every day, but its growth is taxed at, say, 28%, just like you and I are? Well, at least you are, on a daily basis. I've actually relocated to Puerto Rico, where my corporate tax rate is 4%. But for most of us, including me when I lived in the US, I was paying at least 28% tax. And let's face it, we're all paying it every day. So stop and think for a moment. What's that money now worth now? Well, turns out that the answer will surprise you. That penny went to 2 pennies, but then it was taxed. And then it went to 4 pennies, but it was taxed. And these are all rounded to the nearest 1/100th of a penny. But at the end, it actually only grows to $67,000. Now, that should surprise and shock you. 67,659 bucks. That's the negative effect that taxes have on your income. That's a drop from 5.4 million if you needed a reminder. And in case you haven't calculated it, Uncle Sam's compound impact is 98.7%. Now, some of you may have heard me say this before, but for the rest of you, you've got to be in shock. I know I was when I first ran a spreadsheet to figure this out. It's why I decided to move to Puerto Rico, and it's why I do so much investing in my Roth self-directed IRA. There are two powerful forces at work here, and you've witnessed both. The first is compound interest. Within the financial universe, it's the most productive force, I guess, in the universe. And number two, compound taxation, which is the most destructive force. So what's the single most important lesson to be learned by beginning a webinar with this? The big lesson is simple. It's not how much you make, it's how much you keep. And not only can you keep it, you can actually supercharge it in an IRA. Now, why should you even care about private lending? That would be a great question to begin with. And here's my perspective. If you look at the skyline of any major city, what do you see? This happens to be a skyline of London, England. And I lived in London for 3 years when I was going to graduate school. And as you can see, the one thing that you can see that adorns the top of the buildings of all the major cities are banks. So what do the banks know that we don't? And what do the banks not do that we could? Great question. The answer is the answer to the question, who will the banks not loan to in real estate? And the answer is the flippers. You see here the folks who do flip and flop, desert flippers, flipping Vegas. The number one need of these folks is money. And when they need it, they usually need it fast because you can't steal second base in slow motion and deals need to be taken down quickly. Well, banks can't lend in these situations, which is exactly where you and I as private lenders come in. It turns out that if I give you an example, it'll probably be the easiest way for you to understand it. So let's say a self-directed IRA holder like you or me with cash agrees to make a loan to a real estate investor operator, what I call a home flipper. The flipper buys a home for, say, $55,000. They need $15,000 in rehab, so that's about $70,000 in total, in order to rehab it and resell it for $100,000 and make a profit. But let's say that the investor operator, the flipper, doesn't have the $70,000 in cash needed to get the deal done. We both know that a traditional bank won't help, so the flipper turns to a lender like you or me. We're sometimes called a hard money lender, and we'll loan 85 to 100% of all the capital needed. So if he needs $70,000, we'll loan between $60,000 and $70,000, and we're going to get a nice return for doing so, as we'll see tonight. Now, the flipper eagerly takes the loan in exchange for the opportunity to flip the home and get the end profit. And the lenders paid back their principal, interest, and origination fees, so you and I are happy. Now, let's look at the numbers on what I'd call a typical flip loan. I'm using the simplest of examples here. A $100,000 loan, a round number, 12% interest, which is very common in hard money lending, which also happens to be 1% a month. So you can see here that this $100,000 that you sent earned $1,000 a month or 1% per month, $6,000 for the life of a 6-month loan. And if we were able to take that money once it's paid off and reloan it, we'd actually turn that money twice in a year or earn 12%. Now we're going to see later how this return can be supercharged using simple and customary strategies that most lenders don't know, but at least it makes sure that everybody here, whether you've done loans or you haven't done loans, are all on the same page because private lending is for all of you. And the opportunity is undeniable. Flipping popularity has led to private lending growth, and real estate investors do all the work. Lenders simply loan money and get more money back. That's my desired outcome. I want to write a check and get a bigger one back. And the question is, which sounds better to you? So before I go any further, let me introduce myself a little. My name is Dave Steck, as I mentioned at the beginning, and I thought it would be helpful for me to share my why. Now, it probably won't shock you that my why, just like all of your why, is more than likely family. I don't have books or tapes or TV shows. I was born in Pennsylvania. I ended up growing up in a trailer park between Michigan and Indiana. I eventually escaped to college. I graduated from Purdue University undergrad and later the London School of Economics grad school. I spent 20 plus years with Kodak and Disney. My mother and father were so proud of me that I worked in corporate America for big companies. But of course, the only problem was I couldn't get rich while I was making big companies rich. So I early retired and I ended up becoming a tech entrepreneur and again early retired three times to take three 6 month life sabbaticals. The first one was with my son Blake, that you see here on the left. The second one was with my son Josh on the right. Sorry, I've got a little bit of a cold, so I had to take some hot tea here. And the third life sabbatical I took was with my dad during his last 6 months with cancer. The first two sabbaticals with my sons were looking at college and teaching them how to package themselves for admission. And it was a great run. And then I began in real estate not until 2002. My research led me to get out in 2005 and 6 before the 2007 crash, and then got back into the market in 2009, where my sons and I co founded Purpose Built Investments. And we've since done over 7,000 deals. Um, Blake, as I mentioned, is my oldest, even though he looks like my youngest. And Josh is my youngest. In fact, Josh went on to become one of the founding partners of Lending Home and created a massive company and has done exceptionally well. So it became the largest hard money lender in America. And every day I'm reminded of my why. All I ever wanted was for my kids to outgrow me and live a better life with even greater meaning. That's basically it. I'm sure most of you on this call are parents, and all of you want the same thing. Who doesn't want their kids to outgrow them? And fortunately, we've done it together. I also spoken at many conferences, including at Harvard. On the right is 2005, when I predicted that the real estate market was going to implode. They didn't invite me back for 3 years because I was the biggest idiot in the room after I made that announcement. But in 2008, they invited me back to try to do a postmortem on why it happened. And then again in 2011, when I said I was going to go all in Las Vegas, and everyone thought I was nuts. 2008 was really a watershed moment in my life. It was at that time that Merrill Lynch lost $250,000 of my hard earned IRA in the stock market, and they couldn't have cared less. I always make sure that I give Merrill Lynch recognition for losing $250,000 of my money and never having cared. The good news is we only do anything in life for one of two reasons, and that's either to avoid pain or to gain pleasure. And at that time, I was feeling a lot of pain losing that much money. It was a massive amount of money to me at that time. And I had worked all my life to get to a point where I had a six-figure IRA. So I vowed to take control of my future and that of my family. And I realized that no one else would ever care more about my money than I did. And all of you have made that same decision by taking control of your financial future and opening a self-directed IRA with Camma Plan. In fact, that's why you're on this call, to figure out what to do with that self-directed IRA in addition to what you may already be doing. I opened my first self-directed IRA in 2009 and decided to go all in on real estate lending. after I realized something pretty significant. And I'm going to show it to you here in a second. I opened, before I opened a self-directed IRA, in 2009, I opened an IRA at Chase. I moved all my money from Merrill Lynch to Chase, and I made a contribution. So you can see my name. You can see that I contributed to a Roth. It was for tax year 2009. I did it by the tax filing date of April 15th, and I invested $6,000. So what was my interest rate and my annual percentage yield? You may read that and you may think to yourself, that's 1%. No, that's 1/100th of 1%. In other words, if I was good enough to invest $6,000 at Chase, they'd reward me by paying me 1/100th of 1%, or at that time, 60 cents per year. Oh, by the way, that was before the penalty for early withdrawal. I couldn't believe it. And fortunately, I went to an event where a number of real estate speakers were speaking, and one of them was a self-directed IRA custodian, and I opened my first account. Unbelievable. I then recruited the two best workers I could find. Again, my sons. And I convinced Josh to leave the traditional Stanford grad school path. So he had just finished his master's at Stanford, and he was going to be moving on to be either a consultant or an investment banker. And he called me up and he said, "Which would you recommend, Pops?" And I said, "You know what? At some point, working for someone else, you're going to work for an idiot. So why don't you work for this idiot first?" And he literally came to work. And later, Blake graduated from Berkeley and joined us. And our family business was born from nothing. We called it Purpose-Built Investments because we were going to do everything on purpose. And I was living every father's dream. Imagine for a minute, if you have kids, and I'm sure almost all of you do, how many of you would like to make money, do good, have fun with your kids every day, and love it? Well, we did, and did incredibly well. So we did a lot of real estate investing initially, as I'll share with you, and then we did a lot of lending because I prefer to do lending in my self-directed IRA where there's no hard asset like real estate, and it's allowed me to build a legacy and learn a few lessons along the way. We started out as flippers in Las Vegas in 2009. And we worked really hard to become one of the top home flippers in Vegas. We also did a lot of research to become research experts in our home market. We also built a hand-selected network of partners in other markets. We weren't sure exactly what we were going to do with them, but we met them through investor meetings. So how'd we do? Well, after 74 flips in 2 years, where we almost killed ourselves, we had an average annualized return of almost 61%. But boy, were we busy, working 7 days a week, solving problems as they came up, managing people, properties, expectations, you name it, we managed it. Now, a lot of you listening right now have invested in real estate yourselves, but for those of you who have not, just trust me when I say that flipping isn't as fun as it looks on TV. Fortunately, one of our partners in another market gave us an opportunity that permanently changed the trajectory of our entire family and our real estate lives. It was at a real estate investor meeting, and one guy, Mike from Attleboro, Massachusetts, said, "Hey, Dave, I need money for a deal, and I really need it ASAP. You've just sold that property that I was showing on this screen up here. I just sold this property, and there was my son, Josh." And Mike said, "Can you lend me the money from your recent sale?" That was our first private loan. I couldn't even spell private lending at that time. And it was a 31-day transactional funding deal, which I won't try to explain on this call, but it was so simple, and we literally made a 58.9% annual return. Now, I'm not saying that's typical, but I'm saying it's doable. And we've done other deals like that. Our second deal was in Phoenix. It was a $95,000 loan. back in 2011. We earned 4 origination points, 14% interest. The money on this deal was out 105 days. We made $7,626, and our annualized return was 27.9. Now you can imagine about this time, I'm looking over my shoulder, wondering when I'm going to be thrown in jail. And I just couldn't believe it was this easy. Now, it hasn't always been easy, but it is simple. And it is something simple enough that we can learn it and not have any experience in it, not have anyone mentoring us, and do incredibly well. So, how have we done? And how's my Sidra looking over the last 8 years? Well, what I'll tell you without getting into specific numbers, which you wouldn't share if I were asking you, and I won't share, I added 2 zeros to my net worth. I launched 3 investment funds with my sons, including other self-directed IRA investors who invested in the fund. And I just want everyone to know here, I'm not here today to raise money. I'm simply telling you that one of the ways you can make money by private lending is raising money from others and arbitraging the spread. So virtually all of this money that we've made has been from private lending after we did many of those flips. And yes, we've bought and held property and we sold it at a profit when the market went up in Las Vegas. But most of the money we've made has been on real estate through private lending rather than in real estate. And it's been faster than I could have ever imagined. And much of it has been tax-free through my and my son's Roth self-directed IRAs. So we've done incredibly well, and that's why Carl had asked us to talk to you today. We also quickly learned that private lending is the perfect business, especially for busy, less experienced people who want to have passive recurring returns with the best effort to return in real estate. Now, there are 6 F's to real estate. Excuse me. First, you've got to find it. Then you've got to figure it. Then you've got to fund it, eventually fix it, then fill it if you're going to rent it, and then flip it. Those are the 6 F's of real estate. Now, it turns out if you compare the 6 F's on an effort to return ratio, you'll see that the active investor, the flipper, really has to work hard. They have to find it, figure it, fund it, fix it, fill it, and flip it. After doing all that work, all they have to do all you have to do as a private lender is work smart, not hard, by simply funding it. Now, I know this because originally when I was trying to concept the best business that I could possibly come up with in 2010 and 11, after we'd been flipping and realized that there was a lot of effort, I listed 12 things that I wanted. How can I make the most amount of money in the least amount of time with the least amount of expense, the least amount of brain damage, the most amount of recurring revenue, the least amount of taxes, and so on. And as I put this chart together back in 2011 with my sons, we realized that the active investor has more time in the deal, more expense in the deal, and as we went down the entire list, some of them were roughly equal. But in all cases, the private lender was able to tick all 12 of those boxes compared to the active investor. And I really love the built-in risk mitigation. If you're a lender, you're lending on property that an active investor is purchasing at a discount. So you're already at a discount because they're trying to get instant equity, and they're using your money to be able to remodel the home and force some more appreciation. So at the end of the day, the question you have to ask yourself is, who loses money first if things don't go as planned? The answer, the active investor operator. And the second question is, how likely is the passive lender to lose money if things don't go as planned? And the answer is, you generally have between a 25 and 40% cushion before you're impacted. Now that's really good news. For those of you who don't know, The most significant crash that we've had in our lifetimes has been the real estate crash in 2007. And at that time in California, where I lived in San Diego, prices dropped 59% in 21 months. That's 3% per month. Well, it would take you 3 years to finally get to the point at 3% per month, or I should say, it would take you one full year at 3% per month to even get to the point where you would start getting into your money, and that is absorbing the cushion that the active investor would be absorbing. And we're also servicing the number one need of a massive market. Adam Data has published a number of statistics that we track, including total financed purchase dollar volume in real estate. And as you can see, in flipping, there's about $50 billion worth of purchased properties, and about 40 to 60% of that is people use financing with. So there are a lot of all cash purchasers, some of the big hedge funds, some of the big private equity firms. Even I pay all cash for our deals. But in 40% of the cases, people need money. So what are you going to do about it? Well, you're going to look at it as a huge opportunity. Why? Because it's a very fragmented market. In fact, in the last 12 months in San Diego, more than 50% of loans to flippers were by lenders with fewer than 10 loans the entire year. There was only one lender that did over 100 deals in 1 month, or I should say in 12 months. There were only two lenders, Lending Home and Quanta, that did over 60 loans. And as you see the rest of these investors, sorry, you'll see that there were 272 lenders in total that did as few as one loan. So it's a very, very fragmented market. And compare putting cash in 10 rentals versus doing 10 loans. Well, let's say, for example, that you either had $1 million or you had access to $1 million, either because of friends and family or you raised that money in a fund. If you took that cash and put it into 10 $100,000 loans, it would be very reasonable to expect a 15% annualized return or $150,000, which incidentally puts you in the top 6% of income earners in the US. By contrast, if you had $1 million that you put in cash in 10 rental properties at $100,000 each, and let's say that you're fortunate enough on a net basis to earn 8%, that would be $80,000. So it's roughly half of what you'd make in private lending. But instead of having all of these homes and all of these people that you're having to deal with in terms of realtors and other folks that are in the transaction, and by the way, all of the tenants that you've got here, you're in a position to be able to scale a business because you only have file folders. So what's more scalable, a private lending business or a rental business? Well, it's pretty obvious that a private lending business is something that you can scale. We could have never done several thousand flips, but we've been able to do several thousand loans in only 8 years. So for us, private lending is the perfect business. It was active and passive to set up, or I would call it active passive. When you initially set up any business, it's active and then it becomes more passive. And eventually you create a passive recurring model. It's sustainable during various market cycles, and it's replicable and scalable. So I always told my sons at the very beginning, we've got three options. We can either go big, or we can stay small and keep it all, or we can add a zero. You choose. And at the time, we decided to add a zero because I wasn't interested in rolling the dice and going big or going home. But my younger son, Josh, did and built a $1 billion company in private lending. So you determine and control your own risk. You're in the lowest risk position of anyone in the deal. You have a predetermined yield so that you can actually forecast your income. And it's easy to understand when you learn how to do it right. You also get cash flow or income during the month, what I call mailbox money, and or you get a profit share on the back end. Minimal staff, payroll, office, and overhead. In other words, you don't have a adult daycare, as I call it. It's a backpack business. I've literally been able to travel around the world. I've made 15 trips in 2 years to Thailand with just my computer and my smartphone in a backpack. There's no credit or income or track record required. You can leverage and arbitrage other people's money, other people's effort, and other people's time, or all three. And all of you know this, it's tax free if you do lending from your Roth self directed IRA. And by the way, here's some proof that you can reasonably supercharge your IRA. Remember that example that I used before, where we had a $100,000 loan at 12% interest, which was 1% a month, which meant on an annualized basis, we could earn about 12%. Well, what if we kept adding things to it? Excuse me. Sorry, got this cold. What if we could add origination fees, otherwise known as points? So in addition to the $1,000 a month or 1%, imagine that we were able to get 3 points, which is very customary in hard money lending. That 3 points would be $3,000 on a $100,000 loan, plus the interest would generate a 9% cash on cash return in 6 months. And if we do that twice, that is 2 6-month periods, we'll earn an annualized return of 18%. Now, what if in addition to interest rate and points, we added due diligence and payoff fees, which again are customary for a lender? Let's say that you charged $1,000, many lenders do, especially the institutional lenders, for due diligence, and let's say that there was a $500 payoff fee. That seems a little high to me, but we rounded up just so that we could provide the numbers here. That's a 10.5% cash on cash return. You're going to do that twice in a year, 2 6-month periods, and generate a 21% annualized return. Now, what if we shrunk the time period? What if we could get in and out of this deal in 90 days instead of 180 days? Well, then we can flip this money 4 times and generate a 30% annual return with everything else being the same. Of course, we have to place our money in 4 different loans over the course of 4 3-month periods. And if we actually included what's called an equity share or a piece of the profit, in this case, if we were 25%, which we used to do, we don't do as many of these anymore because the margins are thinner, you could generate up to a 60% annualized return. That is crazy, but that is doable. Sorry again. After several thousand loans, we were starting to feel guilty and in fact, I felt like Pablo Escobar or something. Well, almost. On a serious note, we were growing fast, we were working less, and we were doing incredibly well and enjoying our lives. And then the light bulb went on at one of my investor meetings earlier this year. A friend had just sold his business and he asked me, given that you've done almost everything in real estate, if you had it to do all over again and you had some cash, which he did from his business, what would you do? Well, after selling the business, I said, private lending, hands down. It can permanently change your quality of life and your family's financial future as it has mine. Now, if you're new to private lending on this call, you may rightfully be asking yourself really a good question, and that is, where do you even begin? How do you even begin? And what I'll tell you is, thankfully, it's a lot less complicated than you might think it is if you learn from someone who's already done it successfully. And the reason I know that is because we didn't have someone to learn from when we started. We literally had to learn all this ourselves. But now, after more than 30,000 deals, I'm telling you, we've encountered just about every deal, every borrower, market, profit structure. We've done almost everything. And so what I did for this person and for the other group of investors who I was meeting with is we put together a workshop to teach them. And the catch was that I wanted them to refer others so that I didn't have to spend a lot of money on marketing. I simply wanted them to refer others if I was going to teach everyone. And so what started as a do good turned into a 2.5 day live training workshop where we taught all the necessary fundamentals to become a successful private lender on residential real estate. Now, I'll share a little bit about it now. And this isn't with the intention of trying to sell you on this, because I've never believed in that, frankly. I've always felt like you should share and attract those that want to know more. And so, what we're going to do is a part 2 webinar because we just can't cover everything tonight, but we're going to try to be respectful of your time. And then we're going to answer a ton of questions on part 2. So, what I can tell you tonight is what the workshop is all about. And simply put, you learn to lend money to real estate investors. You learn how to find borrowers and deals. You learn how to mitigate or eliminate your risk, how to vet the 3 things that you need to vet: the market that you're going to be investing in, the borrower, and the property. And with technology, it is so much easier than it was when we started roughly a decade ago. We learn how to price your money competitively so you can win more deals without leaving money on the table, and how to follow a safe, secure process when you're wiring funds, when you're working with escrow, when you're preparing loan documents. And you'll also learn how to find and vet opportunities to invest passively in, like private lending funds. Now, we're not going to be presenting a private lending fund to you. It's not that. It's simply that many of you are going to be interested in investing in private lending funds. We have a private lending fund that we've had for 9 years that's been closed to investors for several years, but you're going to probably look for those yourself. You're going to want to learn strategies that our family's been using and will use in 2020 to be able to source deal flow through our network. You'll learn new technology that's disrupting the real estate and lending industry. And I'm telling you, you've got to be aware of what's coming because it's staggering. You're going to learn, sorry, how to use our documents and tools that we'll send you home with. You'll leave with the confidence that is to do your first or your next deal if you're already doing loans. And at the end of the day, you'll be with a group of folks like this if you choose to attend one of our workshops. This was our first workshop in San Francisco, where we had 42 attendees and guests, and there they all are. We shared everything we know. We even invited very, very successful friends. One of my son's friends through his Stanford network is Gary Beasley, who's the founder and CEO of Roofstock, who shared what he's doing with his new passive investment fund. At the end of the day, imagine making money, doing good, having fun, doing it together with a group of people who are all like-minded. It's a pretty special event. In fact, attendees generously offered to refer family and friends, so we hosted another workshop in Tampa. In fact, this time around, it was even better. We refined it a little more. We had a little bit bigger room, and we made new friends to profit together with. And in fact, those that actually attended that workshop would say that they were better looking than the other group. So that's all well and good, but what did they think of the workshop? If the roles were reversed and I were you, I'd be asking that. So what I'll let you do is hear it straight from them because I think it's better that way. We asked everyone in San Francisco, the first event, a simple question. How would you rate the Just Be the Bank workshop on a 1 to 10, with 10 being the best? Now, we've redacted their names here, but the average score was a 9.83. And if you look at just 3 of them, since it's hard for it to fit on one page, I think we got roughly 20 testimonials from orthodontists, from real estate investors. Here's another orthodontist. This is the most precise, in-depth analysis of how to actually vet a deal, vet a borrower, fund your deals correctly, so you can run your own private lending business if you want to. I'd recommend their events to everyone lucky enough to attend. And Mo said, as an active investor, JBB, or Just Be the Bank, gave me the training to build the next stage in our business, which is passive lending. It's so valuable to do both. It's the future for us. They delivered the content just how I needed to learn it. Now we could put it into practice. And Bill said, what I've learned at JBB is allowing me to build a legacy for my children and become a passive active investor. Dave's the man. He's been there and done it. And that gives me the confidence to take the next step in my real estate investing. So we had a lot of great people there. This is Dr. Randy Klein, who's a dentist in Charlotte. And he said, he left me an email after the event and said, hi, Dave. Thanks again for a great event in San Francisco at JBB. After 40 years in dentistry and the last 5 years as a part-time private lender, I now realize after JBB that I've been lucky. I've done a lot of investing in real estate and hard money lending funds and private loans with marginal people, doing inadequate due diligence, using loan docs for my borrowers, and having no real tools to vet the deal or the borrower. I just didn't know what I didn't know. Wow. Something you said really resonated with me. Any idiot could have made money in real estate and lending in the last 7 years with the market booming. But in the next 7, part-time and full-time investors need to be much smarter. Well, after JBB, I'm really glad I brought Scott and Emily so they can grow our legacy, of which private lending will be a big part. Everyone at JBB raved about the event. Kudos to you and Josh for doing good and making us all better investors. Thanks. Thank you, Randy. So it obviously can't get any better than a 9.83, right? Well, we asked the same question again in Tampa, and the score was a 9.96. In fact, one investor, only one, rated it a 9, and we're going full armor and finding that person now and tracking him down like the dog he is. So we've really gotten great reviews from folks. And we also ask a question, how willing are you to refer others to JBB? And we were flattered that we got a score of 9.69. Virtually everyone gave us a 10 that they were willing to refer others. And in fact, at both events, they referred over 100 folks, which is why we keep doing the events. It's the best compliment we could have ever expected. What I can tell you without a doubt is that there's no other private lending training like it. In fact, we know, we've looked, it just doesn't exist because it's a niche within real estate. I think you deserve to learn the skills to do it right. I think this knowledge can unlock the ultimate goal in your life, because if you're anything like me, you're looking for financial and time freedom. It's simply a goal that all of us have, to work less, to have more fun, to do more good, while making the same amount of money or more with a lot less effort. That's what I accomplished with private lending, and that's what I'm willing to teach you. I used to feel like this, both as a flipper and in corporate America, and now this is an event that we do every year in Puerto Rico for a lot of people within our investor community, and that's how we enjoy ourselves while interest is being made. So while I'm on this call with you, I'm not making money from you. I'm making money in addition to this call, simply by the interest out on loans that's paying me money every minute of every day. So what does it all mean for you? Well, based on the success of our first 2 workshops, we're going to host a third. We don't have any other workshops planned after this at this time because we're pretty busy just building our own businesses. Sadly, most private lenders don't know what they're doing. Literally 90 or so percent of private lenders have no idea what they're doing. And I know because we didn't at the very beginning ourselves. But after thousands of loans, we've created a blueprint success formula. The few that really do know what they're doing aren't willing to share it because it creates competition. But we don't fear competition, nor are we trying to build a seminar company. We're simply successful private lenders that enjoy what we do and sharing what we do. So for those of you who are serious about being a private lender, what Carl's asked us to do is a 2-part series, and we're going to do part 2 of 2 in a few days, and it's going to be focused on Q&A and some other really exciting things that we want to share to be able to answer all your questions, because All we could do within an hour tonight is be able to share what we have, plus a few other things. So if you're serious, there's really just three simple steps. And the reason that I capitalize serious is this: most people in life are curious, and that's okay. But I'm really interested in teaching people who are serious because I don't want to waste your time. I don't want you to waste my time. We've got other things that we could be doing in our life. But what I'm hoping is that you'll take three steps to getting on the next webinar. Number one, just go to justbethebank.com. So justbethebank.com. Just go there, not right now, but after we get off. Number two, you're going to see this screen in front of you, and there you'll see a little icon that says send me more info. So just click on that send me more info. So if you go to Just Be the Bank, right near the top, you click on send me more info. It'll take you down to the bottom, or you can read down the page to the bottom and see some of the other testimonials. And it'll ask you to fill out this short form and just hit submit. Now, when you're describing your experience, tell us a little bit about yourself and why you're interested in learning about private lending. So you're going to put in your first name, your last name, your phone number, and your email, just like you did to register for this webinar, and then describe your experience in real estate and private lending. So we have an idea for the next webinar, how much experience there is, because we know there's going to be a wide range, but we don't know exactly how wide. And then once you complete that, just hit the submit button. That's it. It's brain dead simple. Now, if I've lost you with the pictures, or if I've lost you with the code that I'm trying to talk through, it's just three steps. Go to Just Be the Bank, click send me more info, and it'll take you to the bottom of the page. Simply fill out your name, your contact info, tell us about yourself, and click submit. Then you're going to get an email with an invitation to our free part 2 of 2 webinar. So be on the lookout for that webinar or that invitation tomorrow. After you submit that form, you'll get a webinar that references a Q&A call for private lending. On that call, we're going to answer all your frequently asked questions, and we always like to add what we call should have asked questions that you should have asked had you known what we know, but you didn't think to ask. And that's okay, because we didn't know them when we started either. That way, everyone benefits from everyone else's questions, so you don't have to wonder if you've thought of everything you needed to ask. My final thoughts are these. I'm sure you've got questions, and of course, I'm going to answer them on the part 2 webinar. But I believe private lending, being the bank, is the best business model on the planet. The Rothschilds did it and became uber successful. My sons and I have done it too without the Rothschilds' help. So I know you can do it. And whether it's your first or your next loan, I know you can do it quicker and better if we show you how. This is our opportunity to do good, and we're grateful to be able to do so. All you've got to do is simply register for part 2, the Q&A call for private lending. So thank you. I appreciate you bearing with my cold here tonight, my cough, and go to Just Be the Bank, and we will see you on part 2. Have a great evening. Take care.